to Masari's Unqualified Opinions. I'm Ryan Selkis at 2BitIdiot on Twitter. Really excited about the conversation today with Sam Bankman-Fried, who's the co-founder and CEO of FTX, a new crypto derivatives exchange. I guess not that new. You may also know him and his team from Alameda Research, who's frequently ranked on BitMEX's top traders, which is very, very interesting for an OTC firm to be as public as you guys. But I guess if you're launching the derivatives exchange, and it makes a little bit more sense to not just hide in the shadows, as is typical for OTC brokers and traders. So, Sam, first of all, why don't we just take a step back with all of our guests? We like to just get the backstory and the red pill, if you will, for how folks got into the industry and their personal journeys. And then, of course, we'll come up to the present day of how you came to be running FTX.
Yeah, absolutely. So, I guess I started out after college joining Jane Street Capital as a ETF trader, and I was on Wall Street for about 3 years. Then, sometime in 2017, left Jane Street, started up Alameda, and basically just took a look at CoinMarketCap and said, this is completely insane. If this is real, the price divergences between exchanges is insane. The price movements are insane. It just had a lot of hallmarks of a market that needed more liquidity. So started up Alameda and, basically did a bunch of sort of quantitative trading, arbitrage, liquidity providing, eventually built out an OTC desk as well. Grew to about 15 people or so. Trading something like $1 billion a day of volume worldwide. We've been trading for a couple of years. And, one thing that we sort of noticed eventually was, these derivatives exchanges seem to have, a bunch of issues. And, after sort of continued lack of improvement, eventually, started up FTX. That's sort of, a very high level overview of my journey in crypto.
And where are you based?
I'm based now in Hong Kong. So we've got offices, in a bunch of places, but I am mostly full-time in Hong Kong.
Got it. So let's talk a little bit about the crypto derivatives landscape. So first of all, there's cash settled and physically settled derivatives. There are all types of futures contracts. You can have options, you can have futures, forwards. Break down the landscape between some of the existing providers and groups like BitMEX and Wobi that have their perpetual products versus the more Western focused derivatives platforms like LedgerX and Bakkt and some of the others that have come online or are coming online more recently. And give people a sense for how you think about positioning for FTX, both from a geographic and also just a product standpoint. And then also kind of where your thesis is in terms of the burning needs in derivatives right now. Because there certainly seems to be, and this has played out, a certain type of contract that is going to be more useful earlier on than others.
Yep.
And there's a bit of debate on cash settled versus physically settled and kind of where you can do these different things. But it's the Wild West right now. I think it's still an insider's game by and large, although that's gradually changing and getting a little bit more regulated. What's kind of the current state of affairs in crypto derivatives?
Yeah, so it's a good question. And, at its heart, what's sort of the point of a derivative contract? And for now, I'm just going to talk about futures or perpetuals or sort of other, linear products in crypto. So I'm going to ignore options for a second. And the reason, the reason I'm going to do this, that's where the vast majority of the activity is today. Mm-hmm. And, fundamentally, the reason that these products exist is that people can get leverage. If you want to get, 20x leverage on a trade, it's really hard to do that with a delivered spot market. Because everyone needs to keep enormous amounts of capital lever at all times to, actually be able to deliver everything that they sell. So, So, derivatives in crypto make up more than half the volume, which is also true in sort of a lot of industries. This is not specific only to crypto. What's sort of the difference between these? The first thing I'd say is that in a lot of ways, I think the differences are overhyped a little bit. And there's actually a lot of similarities between these various products. But, to the extent that there are differences, I think probably the biggest one is if you look at how settlement and collateral work. And so there you can contrast something like CME or Backed with something like, BitMEX will be, or, FTX, where for sort of the U.S. institutional products, they follow the Wall Street mold of basically use some sort of intermediary clearing firm. That clearing firm vouches for you in terms of like your collateral, your capital. It's like T plus something settlement, often T plus 2 settlement or something. So you don't settle your P&L till a couple days later. Margin calls are sort of a complicated process which involves some negotiation with you and your clearing firm and the exchange, but they try not to really have margin calls ever. And you contrast that with something like, BitMEX, which is maybe the extreme example in the other direction, where it's basically just like you deposit some amount of physical Bitcoins to the exchange, and if your account goes under, you just get liquidated, and that's how it works. And you can withdraw every day. I think that if you look at the big difference between those, the thing that I would say basically is not so much that one system is necessarily better than the other, as that it's really, really awkward if not everyone's using the same paradigm. Mm-hmm. To take a look at that, right, I think probably the best thing to do is say, what if you are hedged? What if you have a long position on one exchange and a short position on another? The thing you're terrified of basically is, you're long 100 Bitcoin somewhere, short 100 somewhere else, and Bitcoin goes up 100%. Mm-hmm. In fact, you haven't made or lost any money, basically, right? Because you had this hedge on, but one exchange just thinks you made $1 million, and the other just thinks that you lost $1 million. And what you don't want to have happen is the exchange that thinks you lost $1 million to liquidate you. You want somehow to be able to transfer your gains from one place to your losses to the other place. And it's really, really awkward if these two exchanges use completely different settlement and collateral systems. And so sort of the nightmare scenario is basically, you've got a long position on CME and a short position on BitMEX. And then Bitcoin goes up a bunch and you get liquidated on BitMEX because CME doesn't pay you P&L for a few days. Similarly, you run into an issue of collateral where, how do you collateralize all these trades? Well, you have to physically post collateral at a place like BitMEX. And then at CME, you have to have some relationship with some clearing firm intermediary who's vouching for your credit or something. They don't know anything about your crypto assets. They're not going to be super excited if you're trying to say don't worry, I just sent a bunch of Ripple to this wallet address. You, JP Morgan, don't have to worry about me anymore. See this address. I can do Satoshi test if you want. It's my Ripple. Let me trade more contracts right now on CME. I need triple the risk limits I had before. And sort of neither, those paradigms just really don't talk to each other. Mm-hmm. And you sort of either want to be constantly moving your crypto around to manage your collateral and settlement and risk, or to have one settlement firm intermediary who knows about all of your money, knows about your portfolio everywhere, and knows what your risk limits should be given that, and vouches for you in all those places and knows that you're hedged. But you have these really awkward things that happen in the middle if places are split between the two. And so because of that, you see almost no crypto adoption of these U.S. institutional places. You look at the big crypto trading firms, it's really fucking awkward to use CME, right? Because what you can post as collateral there, when trading gets busy, how do you increase the amount you can trade there? Say negotiation with a bank in the U.S., that's not how any of the rest of your flow works, right? Mm-hmm. You're used to just sending another 100 Bitcoin somewhere if you want to trade more. And similarly, you don't get paid out your profit for a while. And you're sort of wait, but I need this to go post as collateral on my hedge. But that's not how that system works. And so I think that's one of the reasons. And similarly, you look at account creation. How does that work? In the U.S., it's sort of you create this big regulated corporate structure and develop relationships with clearing firms, and then send the standard set of documents to each of these places. And in the rest of crypto, it's no, you have this standard set of selfies that you take holding various ID cards that you submit to all the exchanges, and they give you an account. And because all of these are just totally different, just all of the operational aspects of these systems don't talk to each other very well. And I think that's, you see a lot of people without any crypto experience sort of starting up the Western style settlement exchanges. And I think it makes a lot of sense from a Wall Street perspective, but I don't think it makes any sense from, interfacing with BitMEX or Binance.
Yep. So we just covered a ton there. So I appreciate that because it's a good lay of the land. Talk a little bit about some of the leveling up that you guys are doing, both technically. So you mentioned the collateral problem. You have quite a bit going on. You've got your own platform token to incentivize trading. You've got a number of indices, which I love. That you have an index that is literally called shit, which is low cap coins that people want to speculate on. Where is like the real bread and butter of the business right now, and how are you guys positioned to take some share in what is a hyper competitive market right now on the derivative side, especially with the overseas exchanges?
Yeah, no, it's a good question. And I think that what I'd say basically is that it's not one specific thing. And part of the reason for that is that there's a lot of other derivatives platforms in crypto, and they all have their own unique flaws.
Mm-hmm.
You try and trade on some of the platforms, and you're like, managing collateral here is a nightmare. There are 10 different wallets. I need to be collateralizing some of these with ETH Classic. Like, who has a lot of spot ETH Classic sitting around just waiting to use it as collateral on a margin trade, a futures trade. You get separately liquidated on each contract, which is a pain to manage. There's clawbacks. And then you look at some of the other places, you're like, well, they only have like one future listed. So unless a Bitcoin perpetual is the thing I want to trade, this platform won't have it. You look at others, their matching engines can't handle the load of peak times. And you look at others, just like no liquidity on the books. You try and buy 100 Bitcoins, you print it up 1%. And so I think that each of these exchanges sort of has their own little niche and flaw. And a lot of what we're trying to do with FTX is sort of iron out a lot of those, is to build the crypto derivatives platform that works for everyone and that sort of combines all the best features of them and fixes all of the worst features. And so, that's meant a lot of different things. It's meant that we've listed a ton of futures. So, obviously we have a Bitcoin perpetual future. We in fact have quarterly and perpetual futures on all the tokens we have. We have a bunch of tokens, not just Bitcoin and ETH. We also have everything from, EOS to Algorand to BNB futures. And then, as you said, we have these index futures, which are kind of cool products. They're everywhere in traditional finance, but weirdly nowhere else in crypto.
Mm-hmm.
And so, if you want to just get leverage long or short, shitcoins in general, you think that sort of the ICO boom is just over and going to die out, or that there's going to be a second wave, you can put a position on our, shitcoin perpetual future, which has, 50, it's sort of, an average of 50 different low market cap coins. We have a mid cap future, an altcoin future. We have an exchange token future. If you want to sort of, place a trade on the performance of, BNB and Leo, will be token OKB. So we have a wide variety of products. We have a matching engine aiming to withstand load even during really busy times. We have a ton of liquidity. I mean, we have millions of dollars every few basis points on our Bitcoin perpetual contract. And we have flexible collateral. So you have one centralized collateral wallet. You put Bitcoin, ETH, USD, Tether, FTT in it, and use it to power all of your trading at once. You don't have to keep transferring things around. So if you want to, you can, using sub accounts. And so a lot of this is just trying to figure out, what is the best version of this product? What are the best versions, what are the best parts of all of these different competitors? And how can we build a product that combines all of those together? And fixes all of the sort of large problems with them.
The issue with all exchanges, whether you're talking about derivatives or even spot markets, is liquidity begets liquidity, right?
Yeah.
So, even to this day, BitMEX is the 800-pound gorilla in the room. The Asian exchanges in general that allow for margin and futures trading are still very large as well. The Wobis and Binances of the world. how do the goal is to build a better mousetrap, better product that solves some of these issues, but what is kind of the most important thing?
Right.
Because is it just the breadth of contracts that can be traded, or does it have to do with just better collateral management and managing orderly liquidation so that you don't have the equivalent of like an FTX wrecked on
Right.
Twitter, like you do for
Exactly.
for some of the other exchanges?
And no, it's a good question. And sort of as you said, there's this real sort of catch-22 that happens when you start an exchange where you can build the best product in the world, but if you don't have any liquidity, no customer is going to want to trade on it. And if you don't have any customers, liquidity providers aren't going to be providing that much liquidity. It's just not worth it. And this is sort of a hard thing to jumpstart. And this is one of the reasons that you see the early entrants into the space still dominant, because they came when there was no one else, and so everyone had to trade there. You look at the OKX futures, the BitMEX futures, and so that was how they solved that problem. But a lot of the newer entrants, so the exchange space in general, just have a huge problem. It doesn't matter what their product is. Like if they can't get much liquidity, they can't get many customers, and if they can't get many customers, they can't get much liquidity. This is one sort of advantage that FTX has because of Alameda. So, Alameda Research is one of the biggest liquidity providers in crypto, trading $1 billion a day, and is providing liquidity on FTX. And this meant that FTX had the most liquid order books basically in the space from the day it launched. And so that was sort of its attempt to solve this, this cat and mouse game where, we just started out with a ton of liquidity, and then we could just go straight to customers and say, hey, the exchange is already there. Like, not only do we think it's a great product, but it already has super liquid order books. You can just come and start trading. And then, as we build up a bigger customer base, we can sort of go back to more liquidity providers and say, hey, I know that this wasn't exciting at the beginning because there are no customers, but now we have customers. Now we're trading hundreds of millions of dollars a day. We had a $1 billion volume day on the sort of big Bitcoin crash day. And so now there's real activity on this exchange. There's real flow, and then sort of work on doubling back and onboarding a bunch more liquidity providers.
So you bring up a good point with the affiliation with Alameda Research, which is where I think most of the team came from, or a good chunk of the team came from.
Yep.
Is that from a regulatory perspective? What type of conflicts does that bring up, right? Because you one common thread or criticism, fair or unfair, and legit or not for some of the top exchanges has been, are you trading against your customers, right? And when you're thinking about market making, are you basically just front running them and doing all the shady shit because you're based in Asia and you're not regulated in the U.S. So like there's a general, like at least in the Western sphere, as like there's a bias against, the authorities aren't like super aware of how this market is structured, so we're just going to be automatically skeptical. And when I think someone hears that Alameda just moved its market making activity over here and helped us bootstrap, it gives people I think a little bit of pause. So how do you manage that, and kind of what are the legal ramifications for that affiliation?
It's a good question. And basic answer is, I totally understand where people are coming from here. I totally understand the worry. I guess what I can say is sort of the following things. First is that, Alameda is a liquidity provider on FTX. We think it's really good for the exchange, but, its account is sort of like other people's accounts. Like it's not, looking at other people's orders. It's not front running orders. It's not doing anything like that. It's just providing liquidity. If you sort of look at the incentives also, like the thing that matters here is sort of making, FTX as successful as possible. That's by far the primary goal here. And, to that extent, like what's going to enable that? Like the thing that's going to enable that is just, making it as liquid as possible and as good of a place as possible for customers to trade on. And that's what sort of matters long term. That's what the real dominant factor is here. I think medium term we'd love for other liquidity providers to replace Alameda on FTX. I think it'd just be great. If there are any who are interesting and want to, we'd love to have you. So Um, uh, this is not sort of a dedication to Alameda being the liquidity provider here. It's it's just like a thing which has really helped the exchange grow early on. But they're not doing anything other than providing liquidity, and we'd love to have someone else doing it if possible.
Got it. We talked about the split between derivatives and spot prices, and it's about 50-50 you estimate in crypto, which is actually low compared to traditional markets. Derivatives markets can be much larger. Where do you see that going in the next year? So has there been a trajectory? Obviously started at zero, and then the introduction of BitMEX was probably the first real liquidity for futures. It's now up to 50-50. Where was it this time last year, and where do you expect it'll be in a year from now?
Yeah, so the 50-50 thing's actually been somewhat constant over time. And I think it's going to move a bit more in the derivatives direction. I think we've already seen a little bit of a shift, but I think this is going to accelerate. And, I sort of expect that over time, we are just going to see increasingly that more and more volumes happening in derivatives, partially as we see more types of derivatives, not just sort of futures and perpetual swaps, but partially as, people come in who want to trade more and more volume. And that sort of is going to be the center of liquidity, the easiest way to trade large size, the easiest way to get put on deltas, the easiest way to hedge. And sort of the trading space becomes more separated from the holding physical token space. I think that's one thing that's kept spot volume relatively high in crypto is sort of, in general, if you look at sort of someone who wants to own a lot of crypto, this often also is sort of someone who doesn't want to just have some, unsettling derivatives contract on some exchange. Often they want to physically have a coin in their wallet.
Yep.
And so I think that's one thing which has sort of been driving spot volume as well.
On spot versus OTC. So how much is in your estimation coming OTC versus settled on exchange for some of the big movers and shakers? Because it's going to vary by region. But that I think has swung wildly. But it seems like 50-50 is probably the right bogey for OTC versus exchange. Is that low?
I would guess that's really high. I think OTC is way lower than exchange.
Really?
Now, it's obviously hard to tell. And the reason it's hard to tell is I don't know what I don't know, right? Like if there's $10 billion a day of OTC volume going up somewhere that I never see, then that would totally shift this. And I can't disprove that.
Well, there's also an element of the infrastructure is so much better now. And that the spreads are so much tighter that the OTC business has gotten harder as well.
Exactly. And I think this has shifted over time. I think there used to be more OTC volume relative to exchange, and it's been dying out as more and more people just start going to exchanges.
Yeah. And not just with options and futures, but with some of the new prime brokerage services and the smart order routing, trading tools and things like that.
I think that's right. And I think that, one thing also that happened, frankly, is a lot of early OTC customers were really price insensitive. A lot of what was driving this insane early OTC trading volume was completely nuts trades. I sort of don't know how else to describe them, but, Coinbase would be a basis point wide, and an OTC trade for 10 Bitcoins would go up 1.5% away from the market. And you're sure, like, how did that happen? The answer is, well, I don't know. That's what the OTC provider quoted, and the customer didn't check that against anything or care, so that's where it traded. And sort of over time, a lot of those customers have started realizing, like, wow, that's bad pricing. And obviously, you have to take into account slippage and exchange fees, and liquidity on exchanges. Like, it's not like you can just get anything done at mid. Like, that's not how markets work. And there should be a spread on OTC quotes, but it should be sort of a reasonable one. And I think that's come in a lot over time and taken a lot of the sort of froth out of the crypto OTC market.
On a kind of mainstreaming front, if you will, there's a couple things to think about in terms of market structure. Price discovery seems to be happening in Asia and on these futures exchanges, especially, I'd say.
Yep.
And I think that's given some of the U.S. regulators in particular some pause because, these exchanges, are they properly regulated? Are they, are they kind of against what the CFTC is typically coordinated? And the answer might be yes and no because it's just a new asset type. No matter how well run the compliance teams and kind of product teams are at these exchanges. There's two questions here. One is, do you believe how many of the crypto markets do you believe are actually efficient markets right now, where spot price is fairly reliable versus and difficult to manipulate?
Yep.
And then that's going to lead into my second question. But let's start there because that seems to be the billion-dollar, maybe trillion-dollar question for crypto in terms of opening up access to structured financial products in a more regulated realm.
So the first thing that I would say is I think I'm mostly going to ignore, I'm mostly going to ignore fake exchanges here because I think they're in a category of their own. You see these exchanges claiming $1 billion a day of volume that actually trade $800,000 a day. Their markets are 2% wide. They have some dumb bot printing trades at mid that are physically impossible. And at this point, they're sort of old news almost. Mm-hmm. They were a big deal a year ago, and at this point, everyone's just gotten tired of them. Transmining sort of a dirty word. Everyone's realized it at this point that that just means fake volume. Mm-hmm. And so you can look at these exchanges. They're exchanges you've never heard of that are at the top of CoinMarketCap, and you just investigate them for 10 minutes. You're like, okay, this is obviously fake. And it's not used in any derivatives pricing. There aren't that many real customers there. No one tries to do a large trade there. So I'm going to kind of put those off to the side because those, you will not get good pricing if you try and trade on those. But also no one really does. Yep. And they're not tied to any of this or core infrastructure in crypto. And instead I want to talk about sort of the exchanges which are the most core to crypto. And for those, I'd sort of, what are they? I think a decent metric, if you go to ftx.com/volume monitor, mm-hmm. You'll see sort of our version of what we think the real volume is. And this is roughly what we think sort of the real exchanges are. But, basically you have sort of the large Asian exchanges, OKX, Binance, and Huobi. You have the U.S. exchanges, which are way smaller, but still pretty important because they are the USD fiat on-ramp. So you have Coinbase, Kraken, Bitstamp, Gemini, Bitrex. And then you have the derivatives exchanges. And it's BitMEX, OKX, Huobi, Deribit, Bitflyer, FTX. And so basically, that's sort of where the real activity is. And you also have some regional exchanges, the Japanese exchanges, the Korean exchanges. I'm also going to kind of put to a side because while they're very important to those countries' crypto ecosystems, they're not very relevant to the U.S. crypto ecosystem. Mm-hmm. And they're not very important to the derivatives crypto ecosystem because derivatives don't key to KRW markets. So if you look at sort of the core exchanges to the ecosystem, on any exchange, if you try and do a gigantic trade, you're going to move the market and you're going to create a premium. The liquidity is not that deep in crypto. And, what does gigantic mean? I think gigantic, you're usually talking, tens of millions of dollars of Bitcoin. If you try and sell $30 million of Bitcoin on some exchange, you're going to move the market. And you'll probably get a bad fill. You'll probably end up, selling it way below what the fair price is, way below what you get on other exchanges because you just blow the liquidity out on that market. But for any of these real exchanges, if you sell $2 million, as long as it's not a market order on some of the least liquid of them, you're basically okay. If you sell $2 million over the course of an hour on any of the exchanges I mentioned, you're fine. And so I think the question, how is crypto, there are arbitrageurs who are sort of keeping these exchanges in line. And so you look at the Gemini order book, which trades $10 million a day or something, mm-hmm. the Gemini Bitcoin USD order book. But if you sold $60 million on it tomorrow, spread out evenly over the day, it'd be fine. And the reason is that, sure, it only trades $10 million usually, but there are market makers there. And if you actually do have that much to sell, you're going to end up losing 5 bips or something, 10 bips to your impact. You'll end up selling a little bit below where Coinbase is, but it's not going to be a massive divergence. because at some point people just jump in and buy.
Yeah. How has anyone done a good job of tracking that? I mean, our team, obviously we're a data company, right? So our team has thought about how to come up with better liquidity adjusted metrics, both for exchanges and also just trading pairs. But it's an important point about Gemini, right? I think if you look at the, even on adjusted volume, the top 20 exchanges, I think they're probably near the bottom of that top 20.
Oh, they're not in the top 20.
Well, I'm not talking about CoinMarketCap. I'm talking about
even real volume, they're not in the top 20.
Really?
I think, yeah. So even if you look at actually real volume, Gemini is quite small volume-wise. It's a factor of 10 smaller than Coinbase or Bitstamp. So, for context, I think that there's something like 25 exchanges that have traded at least $13 million in the last day of real volume.
Mm-hmm.
And, if we pull up Gemini here, how much has it done? It's done 8 million. So I think they're probably somewhere around 30 to 35 in terms of real volume.
Got it. But you would still, again, say because they have these market makers, the true liquidity at Gemini. So what traders care about, they don't give a shit like what the CoinMarketCap number is, right? They want to know where
what they care about is how they can trade, right?
How can I trade with the lowest slippage, with the kind of most reliability, right? So how do you bake that in, right? Is that just something that kind of the OTC desk will do their own calculations with their risk team or their trading team, or are there any good resources or really any way to measure this right now? Because that measurement seems to be an input to just kind of assessing whether the market structure for any given pair is healthy. And that, in turn, is probably the most important missing input for something like the Bitcoin ETF in the U.S.
Exactly. And I think that's a good point. And here's sort of my basic answer to it, is people use volume because it's what CoinMarketCap chose. That's what everyone quotes. And volume got a little bit polluted, but it's also never been quite the right metric. And the reason is this arbitrage thing. Something that's really easy to arbitrage, even if no one usually trades it, is going to have more liquidity than you think. And so I think in general, order book depth is a decent metric. I think if you do something like you look at the Bitcoin USD contract, whether it's spot or futures, and you look at basically how much impact would you have if you sent a market order to buy 100 Bitcoins. I think that's generally a pretty reasonable question to ask. And what you'll see, for instance, is on Gemini, I think the answer, despite the fact that there's almost no volume, if you market order by 100 Bitcoins, I think you're gonna have like 40 basis points of impact or something on the market. Mm-hmm. Which is, it's real impact, but it's not absolutely massive impact. It's a hell of a lot higher than other exchanges. If you want to buy 100 Bitcoin futures on FTX, you have zero impact. There's that size at top of book all the time. And, same with BitMEX. If you do it on, for instance, OKX futures, I think you probably have like 15 basis points of impact or something. So in general, I think this is a pretty reasonable metric. And obviously I made up 100 Bitcoins, but I think that's like about the right size to measure in terms of anyone's going to be fine for 1 Bitcoin, and any order book is not going to be able to support a $100 million market order. But I think if you look at something like 100 Bitcoins as a typical, what's a sizable but not ridiculous order to send, look at order, how far you have to go to find 100 Bitcoins on the order book. That gives you a pretty good measure of how much liquidity there is, how hard it is to impact the price, how resilient the order book will be. And so that's sort of the first thing that I would say. And in general, how does crypto look there? It looks okay, I would say. I mean, it's a hell of a lot worse than equity markets, than liquid equity markets. This is not the S&P 500. This is a lot less liquid than that. But orders like that aren't going to destroy markets. It's not going to destroy any real exchanges order book. And so that's sort of the first thing I'd say. The second thing that I'd say is, because of arbitrageurs, the difference between different exchanges just isn't that big in terms of this. It's really important if you measure your P&L in basis points. If you're saying like, do I make 10 basis points on this trade? So it really fucking matters where you trade. If what you're saying is like, is this index correct to within 1%? It doesn't matter at all. And so, if you look at sort of, what happens when there is a sort of large order that's sent, it'll move all markets. Maybe it'll move one market a little bit more, but unless it's really, really massive, and by there I'm talking like $100 million, it's arbitrageurs are going to keep things sort of in line, again, with 10 basis points or so of leeway. And so, what you see generally is when there's a $10 million sold on BitMEX, it'll move markets a little bit, but it's not going to create a gigantic arbitrage opportunity. It's not like Bitstamp's order book goes to shit or anything like that when that happens. Like, it's just, I don't know, someone sold some Bitcoin, so markets are down a little bit. Like, that's how markets work.
Yeah, I mean, the way to standardize that across exchanges, across, foreign currency pairs, whatever, and then trading pairs, on those exchanges, might be to just pick a number that's around 100 Bitcoins, right? So think about this in like $1 million orders, right? What is a $1 million order going to do to the market if you use a prime broker, right? Something like Tagomi or one of these, new services that's out there that caters to institutions, does all that work for you, or really is a proxy for what the professional trading desks have already built themselves, right? To do smart order routing.
Exactly.
And least cost routing. And then, if you have that, I think that's probably relevant, not just for Bitcoin, but for, all assets. And then you can start to do a little bit more, analysis around the exchanges and around around each individual submarket. That to your point, like $1 million order on Bitcoin is going to be gobbled up by any of the major exchanges, right? With basically no slippage. There does seem to be, though, a pretty steep drop off beyond that. And so you expect to see some of these wild swings in day-to-day spot prices for things outside of the top 10, especially. Because they can be, driven up or down or manipulated much more easily. The other thing that I wanted to talk about, though, and I've not asked this during a single interview yet. And I'm excited to, because it's one of the rare people that actually might have some insight into it that's not just total bullshit. And that is, what the hell happened last week with the 20% drawdown, right? Was there something technical that took place where you saw that and you said you had like an immediate snap idea of what had happened, and just structurally what happened, and with what authority, if you have a thesis, can you kind of put your finger on that versus the retail crypto Twitter know-it-all that actually doesn't know at all what the fuck just happened.
Right. So no, absolutely. Just briefly on the first thing that you said, liquidity really drops off after the top 10 coins or so. I think that, if you look at the markets for, coin number 40 on CoinMarketCap, those are not super liquid. And I would not trust an index on those to withstand millions of dollars of flow. But, for the top coins, I think the answer is, and again, I would not trust a single snap. And so I think if you're designing a derivative in crypto, you don't want it to expire to a single snapped data point. If you expire to an hour-long TWAP, you're basically fine. If you expire to a single data point, then someone could send a giant order in that single data point, and the market might, print down 1% and then print right back up as people bought it up. But as long as you sort of have a long enough time window for the top coins and you're using reasonable exchanges, and the amount of flow that you're expecting during this period is going to be in the, millions or tens of millions, not billions, you're okay. So to go to your point of what happened, obviously I don't know. I'm just bullshitting like everyone else here is. But I have a guess. So maybe I'll start with why did Bitcoin start going down at all? That I really don't know. But if I had to hazard a guess, I mean, it's sort of what a lot of people are saying, right? It's happened with CME, it happened with Backed, a product that got a lot of hype launched and then didn't do anything. And you see this pattern. If I had to guess, you might see people were getting really long crypto in anticipation of Backed, planning to sell out right after the launch. And the launch happened, and then they sold out. And the launch happened, and it traded $400,000. So there's, the giant inflows that they were hoping didn't come. So I think that's sort of step one. I don't know, but if I would guess it's people who are just sort of closing down positions after Backed. Okay, so that's step one, and now you see like whatever $10 million maybe of Bitcoin are sold because of that. I'm making that up. That would serve my order of magnitude estimate. Maybe 20 or something. And where were they sold? It's really hard to tell because at the beginning everything's in line. There's no big arbitrages. Like where is the seller happening? I mean, all the markets are sort of moving down a little bit in sync. But then you hit the dust spiral. And what happens is sort of the same thing that happened when Bitcoin fell down to 4,000 last year, except this time it's BitMEX instead of OKX, where people have on huge fucking margin positions. And it's not necessarily that there's one whale who has $1 billion margin position on. It's that there's like 10,000 people with a large variety of positions, but they all got long, or a lot of them got long. And a lot of them put on 20x levered positions somewhere around 9,500. Somewhere 9,500 and 10,000. And if you add up all of their position sizes, you get $1 billion. Or maybe $700 million or something like that. And obviously there are going to be some big positions in there. There's going to be a lot of small ones. Where are these numbers coming from? They're basically coming from looking at things like open interest on BitMEX perpetual futures. That's sort of like a good way to get an order of magnitude estimate of how large of levered positions the world has on. Obviously there's a lot of noise in that. That's not going to tell you the exact number because some people are short, some people are long, some people are basically unleveraged. There's other platforms too, whatever. We're just trying to get sort of a rough story here. So Bitcoin sells off a few percent, and now someone gets liquidated on BitMEX. And it starts out just one guy. They had a $5 million position or something. They got 20x long. Bitcoin's now down 5%. So they get liquidated. BitMEX sells it off. That sell-off sells $5 million, moves Bitcoin down another 20 bips. And now the next most levered guy starts getting liquidated. And now this spiral starts, right? Where this entire $700 million net levered position between a lot of different parties gets sold off. As, piece after piece after piece of it is triggered by the previous pieces selling off. And this is sort of like what happened in 2008, right? Where like you had a lot of people who were extremely leveraged along shit real estate in the US, right? And yeah, part of the problem is the real estate was shit. So you need that part, but also part of the problem was the world was really leveraged long. And so someone gets liquidated. They have to close down their position, sell off all their shit real estate. There are no buyers. The price starts tanking, and now everyone else's position starts going underwater. And bank after bank after bank has to sell off their crashing assets, and they crash even more. And in fact, at the bottom, they probably crashed too much. Like some of these houses, yeah, they weren't worth what they were originally sold for, but they're probably worth more than their lowest point. But there's just massive sellers of them because everyone was going bankrupt who had a long position there. So you see the same thing in Bitcoin, and what happened is
it's especially true in with these assets because they're priced not valued since they're currencies, right? So it's entirely sentiment driven.
Exactly. You look at something like Apple. If it crashes 80% in a day, Warren Buffett just comes in and says, "Fuck it, I'm just going to buy the company and collect dividends forever and make a lot of money."
Yep. Right.
But with Bitcoin, if it goes down 80%, does it need to go up? It doesn't need to go up. Exactly. It's not like it's an arbitrage to buy it at $2,000. And it's exactly as you said, right? If it's crashing, like it's really hard to know why someone will necessarily buy it. And so anyway, you have this $700 million getting liquidated piece by piece by piece. And you saw this happen. There's like something like that large of liquidation sell side on the BitMEX Bitcoin USD perpetual swap order book. Yep. And you can look at changes in open interest. You can look at they publish when there are liquidation orders. You can look at the just constant 10 million to max. They will liquidate at once, but it's just constantly max size for like minutes.
Yep.
And those all point towards hundreds of millions of dollars of liquidated sell orders. And yeah, if you sell $1 billion of Bitcoin in a day, do you move it down 20%? Yeah, I think you might. And as you said, Bitcoin's pretty resilient to 1 million, 5 million, 10 million. It's not super resilient to $1 billion. $1 billion's a big order in Bitcoin. If you sell $1 billion of it, it's a fuck ton. Yeah. It's going to move markets.
It's basically like all of a day's spot liquidity.
Oh, it's way more than that because it's not all of a day's volume, but there's a lot of back and forth volume, right?
Mm-hmm.
If there's $20 billion that trade in a day, what's the net flow? The net flow is probably like 50 million, right? Like it's probably
that low.
There's,
yeah.
I think it's relatively low. So part of it obviously is you have like HFT firms pinging between different exchanges. So the same trade will cause a dollar to trade on many venues, scraping off a bip here and there.
Yep.
Some of it's that there's sort of a balance between buyers and sellers, and the price just keeps changing until you reach an equilibrium where there's about as many buyers as sellers. And if I had to guess, I would guess $50 million is about the net flow that you see in average day in Bitcoin.
Are there good resources for people to track net order flow?
No, I'm totally bullshitting. And I mean, I don't even know how to calculate this. There's no public resource for this. This is just me sort of going off intuitions of what's it look like in traditional finance, what's a typical ratio between gross volume and difference between net buyers and net sellers, combined with thinking about how much impact would this have. Mm-hmm. If you think there's $200 million a day of net volume, it's a little weird if prices don't move much in an average day.
Yep.
And so I don't feel confident in this $50 million number, but if I had to guess, that's how I ballpark it. And so I ballpark this as, 10 to 20 times that. And if Bitcoin moves 1% in an average day, and that day someone sold 10 to 20 times an average day's net order flow, it moved 10 to 20 times 1% or 2. It's about right. I mean, again, these are really ballpark numbers, but the story is sort of like checks out with that. That is, if you had to guess what impact would $700 million have, 20% on Bitcoin, that if you sell it off in a day, seems plausible. I don't think it would have that much impact if you sold it off way slower. Because if you sell it off way slower, you give liquidity providers a lot more time to get bids out. And the whole thing here, it's not like they're going to be willing to get super long if it's slow, but maybe you avoid the death spiral, right?
Yep.
And the big thing here is that it's not like $700 million really wanted to sell their Bitcoins, right? Probably like $50 million did. And $650 million got liquidated against their will because their account ran out of collateral on BitMEX because markets were crashing in there along. And so a lot of this is not actual real sellers. It's not like people who thought Bitcoin was worthless. It's people who just got liquidated and they had no choice but to sell.
Yeah. Yeah. I mean, I guess the one thing that should strike people as scary under that scenario is the black swan event where Bitcoin truly is banned by a major economy, right?
Yeah.
And now you've got legal issues at all the major exchanges and custodians. How do they handle this unwinding? Our assets frozen, and then all the activity is basically taking place overseas. You could conceivably see $1 billion in net order flow at a macro event like that, and that's only a fraction of a percent of the total market cap, and yet it could still cause a 30-40% drawdown potentially.
Yeah, that's absolutely right, and I think that's absolutely possible. I mean,
or more,
Bitcoin is
or more.
Yeah, or more. I mean, who the hell knows how much? I don't even know how to estimate that. But there's no real limit, right? And that's sort of the scary thing.
The issue is that there is kind of an asymmetric bet to the upside, but it doesn't go up as quickly or as vertically in a even a very positive development. Where a big institutional investor starts, announces that they're buying in, or government blesses it, or whatever. Not nearly the same impact as you'd see if it were the other way around.
Yep, that's absolutely right. And I think that's right. I think Bitcoin, it's pretty resilient to small amounts. It's not clear it's very resilient to large flow, and it's. I just don't know the answer, right? It just really depends on, exactly how levered are people on Bitcoin. You can't even tell that. A lot of it's off exchange. It's split between a lot of venues. You can't just look at open interest to get that answer, although it can give you some sort of guide for an order of magnitude estimate, right? But then you just have whales who they're not even levered. But if Bitcoin goes down a lot, they're like, fuck it, I'm done with this shit.
Yeah. And
they sell off their Bitcoin. And then, and now all of a sudden, that's another death spiral, right? That it's combines with the previous one. And, I think that this sort of black swan event in Bitcoin is pretty plausible, especially as you said, this isn't like a company with a dividend stream that's going to back the coin, right? So it's not like a really rich guy will obviously come in to buy up all the Bitcoins if they crash. Maybe they will, I think it's plausible, but it's not guaranteed.
Yep.
It might not happen.
Well, on that very cheery note, I think this has been super informative. I certainly enjoyed the conversation. I'm sure our listeners will as well, to hear straight from the horse's mouth how these markets actually are structured, which can be a little bit of a black box. Where can people find you, Sam? I know I tweeted out the link, but for our listeners that don't have access to Twitter.
Yeah, absolutely. So, and you can find FTX at ftx.com. It's Foxtrot Tango X-ray.com. You can find us on Telegram. There's a link on the website. You can find me on Twitter. I'm SPF_Alameda. And you can find Alameda Research at alameda-research.com.
Excellent. Well, Sam, thanks again for joining us. Everybody that's listening, I will be, along with a couple of my colleagues from Asari, in Osaka in about 36 hours. Very excited for that. And looking forward to the week ahead at DevCon, where we will be doing a number of live interviews there. So until then, appreciate you joining us. Peace.
Awesome. Thanks for having me.